Great. Well, thank you everyone for joining the Conservation Finance Alliance webinar series. My name is David Myers. I'm the Executive Director of the CFA, and we're really pleased to have Robert Weary from the Nature Conservancy here today presenting sustainable financing for marine conservation via debt conversions. This is an exciting new program that Rob is spearheading that comes from winning the Audacious Project competition, and among other things. And Rob has a real rich history with debt swaps and conservation trust funds, and being involved in the Seychelles debt conversion recently. And Rob was also involved in helping set up the Caribbean Biodiversity Fund, and was involved heavily in the Caribbean Challenge, and he's done some amazing work. He's been at Nature Conservancy for 20 years, and we're really excited to have you here, Rob, and I'm going to pass it right over to you. And what we're going to do is we'll have the presentation, and we'll have time for questions at the end. And you can write your questions into the chat box. You can also unmute yourself when we get to that point if I start asking, and ask questions directly. But please give us a heads up that you have a question via the chat box. And I'm going to pass it over to you, Rob.
Great, thank you. Good morning, everyone, or day, wherever you might be. Thank you for the opportunity. Before I start, I'm just a little bit on the term debt conversions. You also probably have heard debt for nature swaps, debt restructuring. It's all more or less the same thing. I've personally been moving away from using debt for nature swap because a couple of reasons. Global financial crisis was, if folks remember, it was swaps that mortgage-backed swaps that precipitated that, and so it has a negative connotation. And also sometimes I find that some stakeholders sometimes think they're swapping their nature for debt, and so I've been personally moving away and using a debt conversion, although sometimes I still slip up and call it a debt swap, but just on the terminology there. So moving forward, so what are we trying to address? Some of the challenges in small island developing states, and we're expanding this out now also to coastal countries, but the idea came out of addressing issues with small island states. Obviously, I think we all know that marine systems are under threat from a lot of different issues: overfishing, pollution, climate change. They're underrepresented in managed areas, and they, of course, lack funding. Many countries have high debt loads, often attributable to natural disasters. We can look at what happened in the Caribbean a couple of years ago with the various hurricanes and damage in some countries. Dominica, for example, was 250% of GDP. Small island states often have, and coastal countries, just globally, have low GDP. Combination of high debt and low GDP means it's limited fiscal space to invest in environmental protection and adapting to climate change. And beyond being vulnerable to natural disasters, a lot of small island states and other countries can be impacted by global financial crisis. Take the Caribbean, where half the GDP comes from tourism, and if there's a recession, tourists don't travel, and that'll have a negative impact as well. On the positive side, there are a lot of good things. The Caribbean Challenge Initiative, for example, Micronesian Challenge, West Indian Ocean Challenge, groups of countries coming together and making commitments to expand marine protection, and even in the Caribbean to develop sustainable finance mechanisms. And under the Caribbean Challenge, we've been developing a lot of the financial governance architecture that we can use for doing these debt conversions: the national level trust funds, and then the Caribbean Biodiversity Fund, which is a regional endowment. And then this is also in response to what small island states put forward in the Rio +20 meeting back in 2012 about the blue economy, and in particular, the area that we are wanting to work with countries to support is the improving fisheries management, improving coral reef management, and adapting to climate change, ecosystem-based adaptation, and to address that in a holistic fashion. So that's the focus of these debt conversions, is to provide resources to countries around this blue economy theme. And it's great now that we're even seeing coastal countries adopting that same blue economy focus. So what the history of debt conversions, the debt for nature swap, emerged out of the debt crisis in Latin America in the late 80s. The US government canceled almost $900 million of debt to 7 countries in Latin America. And while the US wrote it off their books, they said to these countries, well, we expect you to spend some portion of it. Some portion was probably written off, and to spend it on development activities, be it health, education, or environment. And that was the first example. That's a bilateral swap because the debt is between 2 sovereigns. It is also possible to do commercial debt conversions, but of course it requires being able to buy the debt back. And debt trades, trillions of dollars trade, daily. And there's a formula for figuring out a future cash flow, which is basically what a debt obligation is, and it's net present value. And that is where you have the opportunity to buy debt at a discount. And you can buy bilateral debt as well at a discount. So model will work either way. The old-fashioned debt swaps of a country just writing the 100% of the debt off on their books and letting the country spend a portion a second time, don't see too many of those anymore. So TNC's experience, we did a few commercial debt swaps.
Rob, just wanted to give you a heads up that your slides are not advancing.
They are on my screen, so that's weird.
Okay, all right, and our screen's giving only sort of not in a, it wasn't full screen, it was only partial.
All right.
Do you have dual screens at home?
Yeah, let me.
That might be the challenge.
Okay. All right. All right, are you seeing that?
Yeah, so we're seeing the but not in full screen. See if it works in full screen.
I'm in full screen.
In full screen. Okay. Let me try to bring it up on mine and see if that works.
I'll stop sharing.
Okay. Let's see. Okay, so tell me which slide to be on here. And
so slide 6, the one that says TNC's experience.
Is that working for everyone?
No, the screen is black when you go full screen.
It's black?
Yes.
Okay.
Now I see it.
Right, but it's not full screen. Okay, well, let's just go with this so we don't lose too much time.
Okay. If you would put it in slideshow, though, it'll help when we get to the.
Well, let me try one more time then.
Okay.
Did it go black again?
It did.
How about now?
Nothing.
All right, well, we're going to unfortunately have to go with this. I'll make it as large as I can.
So TNC's experience, late 80s, early 90s, we did a few commercial debt swaps. These were in Central America and in the Caribbean. That was before my time. Most of our experience came out of doing 11 deals through the US's Tropical Forest Conservation Act. I worked on the first one we did in 2001 in Belize, also on the Jamaica, Costa Rica, and Guatemala deals. What was really important out of those deals was the bottom number there, the 240 million in principal and interest payments that were created through those 11 deals for forest conservation. So we were obviously pretty big fans of those. And then the TFCA was not funded for a number of years. Recently was just started up again, but there's only a few countries left with any significant debt, about 3 of them. But we, as well as an organization, wanted to start to look at how we could use this mechanism to focus on oceans, and that led to us doing the Seychelles debt conversion in 2016. Next slide, please. In that one, it was a debt buyback and restructuring of 22 million of sovereign debt. So this was a debt that Seychelles owed to UK, Belgium, France, and Italy. We'd hoped for a bigger deal, but it for various reasons. Initially, we were aiming for about an $80 million deal. For various reasons, it shrank. And as well, where our discount ended up only being 7%, and that was because the Seychelles took us 4 years to put the deal together, and over that time, the Seychelles had been in a debt crisis, had been in an IMF program, but they were a poster child for how to deal with a debt crisis. And they were running 6% budget surpluses. They dropped their debt to GDP ratio from 150 to 75%. They successfully floated their currency. And part of the reason you get a discount is the creditors' perception of whether or not they're going to get repaid. And so because the Seychelles was on a good trajectory, the discount, when we first started modeling, we were expecting a 20 to 25% discounts, and their commercial debt traded at a 20-cent discount. But by the time we closed, their commercial debt was trading at nearly face value par. So, but still we managed to, and in this deal, TNC lent 15 million off our own balance sheet and raised 5 million in grant capital, so 20 million to buy the 22. But it still results in $8 million of funding for marine conservation, and we'll capitalize endowment of $7 million. But a key part of this was the Seychelles commitment to expand their marine managed areas to 30% of their exclusive economic zone. And you can see there, Seychelles is a huge EEZ, sits off the coast of Africa, and 40% of that is 400,000 square kilometers. That's an area the size of Germany, and half of that in high biodiversity areas, which are no-take areas. The Seychelles is at 0.1% in marine protected areas when we started the deal. They are now up to 26%, and working on identifying the last 4% currently, and we'll put those into protection by the end of this year. And so that was done through a marine spatial planning process, which is a science-based, stakeholder-driven mechanism, and brings all the stakeholders who use the ocean to the table to jointly agree on. It's really creating a management plan for 100% of the ocean. So 30% of GDP in the Seychelles is fisheries, 60% tourism. So obviously those two sectors represented, but you also have Petro-Seychelles, who's looking for oil. You have major maritime, marine transportation lanes, renewable energy siting, etc. So all of those parties were a part of this marine spatial plan. So post Seychelles, it was asked to scale up this, and to do it not with TNC money, but to raise money, impact capital elsewhere. It's unfortunate that we can't do this full screen, because I would bring out all these pieces separately. But so you can see the key entity is that in-country trust fund. You can see all the arrows go in and out of that. This is usually going to be created through the Companies Act in the country, and then gets tax exempt status. It's a charity, has a majority non-government board, This entity is a grant-making entity, not a implementing entity. So, for example, in the Seychelles, the board there, we have 4 government seats and 5 civil society seats. Government has Ministry of Finance, Ministry of Environment, and then Fisheries Ministry is represented, and then also the Island Development Corporation, which is a state-owned entity that manages all the offshore islands. And then from the civil society side, of course, TNC has a seat on the board. We have the Hotel Tourism Association, the Chamber of Commerce and Industry, so we get private sector representation. The Fishing Association, there's a Fishing Association represented, and then we have an open seat that rotates through local conservation NGOs. So that's a similar model, and in any other country we would look to create a trust of that sort of representation. So in this deal, this is an example of one we're working on currently. So the Blue Investment Fund is a 100% owned subsidiary to TNC, and that entity will borrow $25 million from a commercial bank, and it will on-lend it to the trust. Now, obviously, we want to make this attractive and to raise the capital at a low cost. We want to de-risk that loan. So the Blue Investment Fund will purchase a political risk insurance from an entity such as the U.S.'s Overseas Private Investment Corporation, and so that way that loan amount is protected. So that is on-lent to the trust, and let's say in this case it's a 10-year, $25 million, 7% interest rate loan, and unfortunately we also have some grant money from the KfW, the German Development Bank, 15 million. So we have $40 million, and in this case we expect to be able to buy 85 cents on the dollar. This is commercial debt, and so 40 million will buy us 47 million there in step 2. We will give the government a bit of debt relief. We'll write off 5% of the face value of the debt, so that's 5% of 47 million. That's the 2.3 million. The debt we're purchasing is around a 7% interest rate, and in the restructuring, we will be able to bring the interest rate down on the conservation note, which is the second note, to 4%. So that saves the government another 2.4 million in interest savings. So that's over the life of the deal, which is 20 years. So the debt relief to the government in this case is about 4.7 million. And then we restructure this debt with the government. That first note mirrors the note from the LLC. So it's a $25 million, 10-year, 7% interest note. And the government pays the trust pays back the LLC in step 5. And then the LLC pays back the commercial bank. And the whole reason we do this, though, is that second note of almost $20 million. That's the conservation note, and that is a 4% interest rate over 20 years. And in step 6, we fund the conservation activities on the ground, which works out to about $940,000 a year over 20 years, or 18.8 million. And then we put about $500,000 or 10 million over 20 years into an endowment. With the endowment, all the investment returns reinvested. So at the end of 20 years, we end up with an endowment of upwards of $18 million. The idea being that in year 21, when that second note finishes, the trust can start to use the investment returns, and assuming a 5% payout, will pay out about $900,000 a year. So what we're doing is creating a sustainable finance mechanism that will go into perpetuity. So next slide. So what do we fund out of this? If you think back to the idea of the blue economy and improving fisheries management, improving coral reef management, and adapting to climate change, it's not surprising that these are what we fund. Biodiversity conservation and management, disaster risk reduction, ecosystem-based adaptation, ecosystem-based fisheries management, etc. And obviously, if the country is creating more marine protected areas, a lot of the funding go to helping to pay for the management of those areas. Next slide, please. So one other thing that we're doing, and in the Caribbean, coming back to the point of the hurricanes, the trust will purchase parametrically triggered insurance product. We've been working with Munich Re on this, and it'll purchase a coverage of $5 million, which is equal to 1 year's payment into the trust for both notes, the $25 million note and the $20 million note. And the idea being that in the case of it being paid out, the trust would then not the government would not pay in to the trust 1 year's worth of payments, thereby freeing that $5 million up for hurricane recovery by the country. And the beauty of a parametrically triggered product is that it pays out within a week or two. It's very fast. And so this will always be in place. So the net is that we basically taking away the risk of a country not being able to make payment because of a major natural disaster like a hurricane. And this will also can cover major rain events as well. So, it could be very specific on what is covered. Next slide. So to sum up all of the benefits to government in this, so there's almost $30 million of debt redirection. And that portion that is used and spent on the ground to fund the conservation activities is payable in local currency. The payment schedule will be in dollar denominated, but on the day that the payment is due, we'll use the spot rate exchange rate. So the currency risk remains with the government and not the trust, but it's still obviously a benefit to the government to be able to pay in local currency instead of hard currency. There's debt relief totaling almost $5 million between the debt write-off and the interest savings. The debt that in this case, we were targeting was a 9-year average debt. The two notes now have a 14-year average, and we've reduced the average interest rate from 7 to 5.5%. And then as well, there's the annual hurricane coverage of $5 million. Both government and non-profit entities are eligible to receive funding from the trust. And in this case, in the Caribbean, where the CBF, Caribbean Biodiversity Fund, is paying out already to the trust funding, it'll serve as match. And the CBF was set up as an incentive fund requiring governments to create a matching mechanism. So this will do that. And then the funding will help pay for finishing the marine spatial plan as well as cover cost of the MPA management. Next slide, please. So what does TNC do? We're going to work with the government to raise grant capital if necessary, impact capital, and in some cases we don't. Getting the grant capital can be time consuming, and as folks know, and so in some countries we are scaling these deals up so that we get the same sort of outcome, but without any grant capital. That only works in countries with higher debt loads, but there's one deal we're looking at. Be a large continental country where we're hoping to bring in $500 million, and then when we buy at 80 cents on the dollar, we can buy 625 million of their debt, and that creates 125 million of free cash flow. So so demonstrating that we can do this without grant capital and by scaling it up. We work to get the credit enhancement, either there's options with the World Bank for loan guarantees, or as I mentioned with OPIC with their political risk insurance. We have pro bono legal services to write all the legal agreements, and we also have grant capital to fund the marine spatial planning. And to tie this in with the TED Audacious that David mentioned at the beginning, so TNC, we have scaling this up and put together a $40 million budget, which will allow us to try to do 20 deals over the next 5 years. And most of that money is, some of it's going to NatureVest and allowing us to hire more staff. I'm actually making an offer on a new deal lead for Africa. We're hiring a trust fund specialist. We're starting interviews in a couple of weeks, and then another deal lead for Asia Pacific. We're also hiring 3 marine spatial planning specialists and a lot of additional staff at the country level for leading the marine spatial planning processes. So most of these resources go to actually pay for the marine spatial plans in the countries. So we're pretty excited about being able to scale this up. Next slide, please. So what does it take to pull one of these off? Obviously, we need the country being willing to do the debt conversion, agree to the marine spatial plan, and also to sit on the board of a trust. We need to be able to find debt that we can buy back. It's not always available, to be honest. Multilateral debt is unable to be used because by their own rules, they can't sell debt at a discount. Bilateral and commercial debt obviously are what we would target, but not every country does the debt sell at a discount, and that's really the secret sauce. That's how we create the free cash flow for conservation if we don't have grant money to buy the debt. And then, of course, we need the financing, grant and or loan capital with some sort of credit enhancement. And then to close, we need the trust fund created in operational and legal agreements. So we've pretty much figured out the financing and what we need to close a deal. So really the focus is identifying countries that want to do this and where we can find debt at a discount. Next slide, please. So the current pipeline of countries, a number in the Caribbean, Grenada, St. Lucia, Barbados, and then we're working with Argentina and Kenya. We have a list of about 30 countries that we've identified, and we're talking to a bunch more. But we're hopeful that we can close a few of these before the end of the year or early next year, making pretty good headway. Next slide, please. So some of the lessons learned, this is my last slide, patience. Obviously these things can take time, although one of the countries, we've been working with Barbados. We just started talking with them last October, and we're hoping to close that in December. So showing that we can close a deal in just a little over a year is pretty exciting, considering that it took 4 years to get the Seychelles deal from inception to close. Scale matters at multiple levels. Make this worthwhile to everybody to do. But also to create the cash flow necessary to address these issues. Not surprisingly, Ministry of Finance is key. There's two co-leads in all of these deals. We have Ministry of Finance and then usually Ministry of the Environment or Ministry responsible for fisheries. Obviously, in the hierarchy of government, Ministry of Finance is usually much higher up than environment, which we usually find to be, unfortunately, at the bottom end of the spectrum. So it's great to be working with Ministry of Finance on these deals as well. It changes obviously our relationship with government. Broad stakeholder consensus is important. The marine spatial planning process requires that. You want that also in the board representation. Getting high-level commitments are very helpful. The Seychelles example, in Rio, we did a high-level event and had the vice president speak. And in that event, he said that they would commit to 30% protection if they could get a debt conversion closed. And so obviously getting a vice president in a country to make that commitment helps. The concept's been very well received. As I mentioned, lots of countries we're talking to, donors, funding, and then also investors. Then what's been really exciting is the fact that we figured out how we can raise huge amounts of loan capital directly from private markets, basically commercial banks. Obviously the de-risking with the credit enhancement helps, and then as well that we can de-risk for catastrophic risk through the catastrophic coverage, which we're also excited about. So that's the end of my presentation. That should give us a good half hour to discuss and take questions.
Excellent, Rob. Thank you so much. Really fascinating and potentially hugely impactful program that you've gotten. So first off, I just want to say congratulations on expanding this whole endeavor, and wishing you the best of luck for that. Let's go to some questions. Yeah. Let's see. So
David.
Looks like, yes, someone's coming on.
Yeah, it's Fenusu. How should we do?
Fenusu. Good. How are you?
Yeah.
Go ahead.
I'm fine.
Go ahead.
Okay. Yeah. First of all, thank you very much for the presentation. It was very interesting. And so, straight to the question, is it possible for you to expand a bit on your 7th point in this, in your last slide? And the link between
on the lessons
this
learned
and,
slide?
yes, the loan.
So, on the de-risking for the sovereign and catastrophic risk?
No, it is in the lessons learned, possible to raise loan capital.
Yes.
Yeah,
Yeah, so
this point.
yeah, so so that basically we're doing these deals with what would be called impact capital. It's loan capital at the end of the day, borrowed money. And so how we're doing that is that TNC will set up 100% owned subsidiary and LLC, which will directly go to, we've been talking to commercial banks, so the likes of Credit Suisse and JP Morgan, Citibank, PNB Paribas, Standard Chartered, Santander, and they all have impact investing portfolios, and they're looking for deals like this, and so they will lend directly to us off their balance sheet. We had, to be honest, we had thought we might issue bonds, and we were going to call them blue bonds, and so you may have heard this project referred to as blue bonds. We aren't actually issuing bonds. When we talked to the banks said, well, we can issue a bond for you, but we're going to charge you 75 basis points, 0.75% of the loan value, the number of bonds we issue to structure it, and then $20,000 a year to maintain those notes. So a 10-year, $25 million note, we'd pay $400,000 to issue it. And the bank said, well, we can just lend to you right off our balance sheet. And why would they be willing to do this? Well, because we get the political risk insurance, and so that covers the 25 million in case of default. So the banks will lend to us at a rate. We have to pay for the political risk insurance, and that is paid for out of the LLC, but it'll add that cost on to the borrowed amount. So if we borrow at some rate, and then we add on the cost of the political risk insurance, and then the LLC on lends to the trust. So that's the way we're raising the loan capital directly from commercial sources.
Okay, thank you.
Okay, thanks, Rob. Yeah, there's quite a number of questions that people have typed in, so I think I'm going to just go in order. If you are able to unmute yourself and want to ask the questions, but I'll just let people know. Romus, you'd be the first one, and then Camilla. So if you're ready, if you want to ask the question, just unmute your microphone and shoot. Go ahead, Romus.
Hey, Rob. I actually was using Romus's computer. This is Jen from Conservation International.
Sorry, Jen. You look a lot like Romus.
I don't know if is that. Yeah, I guess that's a compliment, right?
For me.
Yeah, Rob. Thanks for the presentation. It was a really great overview. My question was, in the Seychelles case, could you elaborate on sort of what was the source of the government's debt payment when you did this and you restructured their debt? Were the proceeds that the country used part of the general funds, so tax revenue from the country, or was that on the sovereign side some sort of special issue of debt, like for some purpose infrastructure, or some of these interventions that were identified in the Marine Spatial Plan?
Yeah, so this was, we bought existing debt and restructured it, and so it was already in the government budget to pay back those creditors, so UK, France, Belgium, Italy, and so now they're just just out of general revenue debt service payments, and now they're just redirected towards a portion is now redirected towards the conservation activities in the Seychelles, and so that would be the case in any of these deals. It's just existing debt that's restructured and redirected, and payment comes just out of the general budget.
Thank you.
Great, thanks. Camilla?
Hello, hi everyone. My question is more related to the CTFs. It's about the arrangement that you did in Seychelles or the other countries that you are thinking of. If you consider covering the full admin or operational costs of the CTF, if it's a new CTF for the period that it's supposed to operate, because I think it's a struggle for all CTFs to cover its own institutional costs. And in several arrangements, this was not considered to be fully covered by the arrangements, as everybody wants to see most of the money go into the field activities. So are you considering this aspect of the financial sustainability of the CTFs in the long term?
Absolutely, yeah. So I failed to mention that when I was getting into the mechanics, but yes, the trusts are allowed to use up to 15% of the free cash flow, so the money going out the door for conservation for overhead admin costs. So in this example, where you have almost $1 million a year going out the door, free cash flow for conservation, 150,000 of that would be available to the trust for its administrative costs, with the remainder for conservation activities.
Okay, thanks. Just a comment on the answer. Most of the funds that we are working with, they cost about 50% in the first years, and then they can get 15% depending on the amount they disburse, right? So maybe the learning curve or the first years needs a bit more than 15%, even if they start with $1 million of disbursements.
I definitely, I've helped, I helped set up the Seychelles Trust Fund from scratch, the Caribbean Biodiversity Fund from scratch, and a number of the other ones in the Caribbean as well. So yeah, I'm very familiar with the startup costs, and we have allowed 25% in the first 2 years for the extra startup costs. We're also trying to scale this up as well, so that we even get to the point, some of these deals where we're looking to do $500 million will create $4.5 million of cash flow, and so 15% of $4.5 million, you're starting to talk about real money. Obviously, the goal is to get as much money out the door, but you can't do that if the institution and the entity responsible for that doesn't have the resources. So, it's a fine line, and we'll obviously work with with the trust and setting it up and looking at the cash flow and the necessary budget to make sure that they have the resources to do what we're asking of them.
Thank you.
Great, and Rob, now I have the next question from Olivia, who's unable to unmute herself. But she has two questions. So one is, what legislation, if any, is required in the seller country?
None, because we are buying the debt back at fair market value, net present value. So, and the debt trades, often commercial debt, often trades, every day, and so there's a price already set. In a bilateral debt, you have to go and negotiate, but it's really, you're using the net present value formula. So no legislation necessary.
So it's just basic commercial transactions for the most part.
Yeah.
Great. And then her second question was asking if you could give some examples on how the conservation money is allocated or distributed for conservation. Does the fund decide, assuming that the fund is independent of the government? Is it exclusively for marine conservation? And how do you make sure that governments don't use it for other sectors?
Yeah, so that list that I showed back in slide 9 gives an example of the activities funded, and those would be written at that sort of scale into the agreement. But we want the decisions on how to, to put those funding, to decide how to divvy up the resources in any given year, to be made as close to the ground as possible. So that's done by the board. And in fact, there'll be a grants committee, which will also include, so in the Seychelles example, the grants committee has, I think, 15 people on it. So you bring in a lot of folks from outside of the board, from various sectors, government and civil society, to determine what the priorities will be. And they assist with, reviewing the call for proposals, etc. So, so the entity itself and the board and the grants committee, make the decisions. But we want it to be in line with national goals and needs. But obviously, because this is focused around the blue economy and improving fisheries management, coral reef management, adapting to climate change, that's the big picture. And then on an annual basis, the board will work with stakeholders to determine the specific projects.
Great. Yeah, and the sort of classic structure of a trust fund. Sorry, did someone have a question? I've got a few more coming up.
Yes, thank you, David. Thanks, Rob, for the presentation. I just need a bit of clarification. Sorry, this is Harrison speaking. Hello?
Hello.
Okay, yes, great.
Right. Thanks, Rob. Could I get some clarification on the position of the trust in the debt conversion arrangement? I figured that the trust is an intermediary, but it wasn't clear to me exactly how the trust is involved in the actual arrangement. Said we did a conversion, our trust did it. How would the trust fit in? Would it that the trust sign the debt conversion agreement with the person who is with the agent or the company that's buying the trust, and then an arrangement say with the government? So I wasn't quite sure when you did the conversion model how the trust would actually fit into that from an actual agreement point of view.
Sure.
So if you could just clarify that for me, please.
Yeah, absolutely. And David, if you'd go to slide 8, I'll walk folks through. That's the shows the mechanics of the deal. So yeah, as you see, there's a number of loan agreements and legal agreements, and so there is a loan agreement from the LLC to the trust that would be signed by those two parties. There will be a buyback agreement between the trust and the creditors, again signed by the trust. And then there is a legal agreement, conservation, a debt conversion agreement and notes signed by the government and the trust and the LLC. And that includes those two notes from the government to the trust. And the agreement is what lays out how the money is spent, and also the expectations of the government to expand protected areas based on a marine spatial plan with a timeline for doing that. And so all of these documents are, so it's sort of like when you buy a house and you go to a closing, you go and all the money transfers hands on the same day, and all the legal agreements are signed at the same time. Obviously the trust has to agree to participate in the whole process, so it'll go to the board of the trust, and the board will, agree to participate. They will sign off on a term sheet with TNC and the government, and as well, they'll review the legal documents as they're created and drafted, and then sign off on those, and then obviously at the end of the day sign those. And in this case, there's also a grant agreement signed between the trust and KfW, the German Development Bank. And so lots of legal agreements, and that's why we're fortunate to have great pro bono attorneys to help write all those.
Okay, on the repayment side, would the repayment go through the trust, or would it go straight to the creditor? Would it go through? Would the trust be responsible for ensuring, for instance, that the government repay? Would that be placed on the trust?
Yeah, so the payments, both payments on both notes come to the trust, and so the trust then is responsible for paying back the LLC. But if the government doesn't pay the trust and the trust is unable to pay back the LLC, that's where the political risk insurance would kick in, and the LLC would be forced to go to arbitration, win an award to force the government to pay. But you know, all of these notes are pari passu, meaning they're equal. It's an equal debt obligation of the government to these trusts as any other debt the government has. So, you know, governments do not, mostly governments do not willingly default on debt. You know, they may get into a position where they need to restructure debt because they get into a crisis due to a hurricane or a global financial crisis, which reduces revenue. But you know, obviously the trust would work with the government to restructure if necessary.
Okay. All right. Thank you.
Thanks very much. I'm going to go with some of the questions that have been written in order. I have Lucretia, and I was going to read it out unless you want to. Following up on to the second questions, are there other sources of funding for debt repayment considered in current or future conservation trust funds?
So,
I guess the question is, are there other sources of funding for debt repayment?
So meaning for the government to cover the cost of repaying the debt? Yeah, obviously governments can put in place, new taxes, fees, or whatever to, cover, to create the revenue that you need to cover that. But, yeah, I hope that answers the question.
Yeah, and I guess right. I mean, if it's a sovereign debt repayment, I guess the government has that covered, and maybe for more commercial type debts, you could use other sources of funding like entrance fees or something like that. But that's down the track a bit. So I have a question from Warren Lavi. Warren, did you want to unmute yourself and ask, or should I read? Okay, well, let me just read it. You noted the limited capabilities of many ministries of environment. Do you focus on capacity building at the trust level, or do you try to improve capacities at the Ministry of Environment level?
Yeah, it's a good question. So within the trust, we definitely, want to build their capacity, including the board's capacity. So we set these trusts up. We'll do board training. Usually, the first board meeting is a 2-day board retreat, where officers are elected and all the operating documents are reviewed and adopted, and everyone learns what their roles and responsibilities are on the board. And then similarly, when you bring staff on, you want to build the capacity of the staff. This is the entity that is obviously going to be managing all these resources, and so you want it to be fully trained and able to do that. But on the other hand as well, we have been noting that it can be sometimes for especially civil society entities, but even we've seen it with government entities, their ability to write the grant proposals to access the funding can be limited. And so we are building in resources and making resources available from the trust to support, to do training, to support, and even making money available. In the Seychelles, for example, small grants are available so that the applicants can actually spend the time necessary to put together a grant proposal. So, and that could even be a Ministry of Environment where you can help train the staff so they know how to access the resources like any of the other entities.
Excellent. Great. So I have a question from Jimena. Thanks, Rob. What are the debt characteristics that enable the conversion? You mentioned that bilateral debt, I think you mentioned multilateral debt doesn't work. What are other deal breakers?
Yeah, so if you can't buy a debt at a discount, it doesn't work. So there's definitely countries that are, and usually a country that's creditworthy, their commercial debt will trade at a very little discount, 1 or 2 cents. So really that doesn't work. There's definitely some sovereigns who aren't interested in selling their debt at a discount for a variety of reasons. They like to have the relationship with the debtor country, and the U.S. is very difficult to buy debt back. It requires an act of congressional appropriation to cover the portion of debt that is discounted. And I think folks know that our Congress is pretty dysfunctional. So we were looking at a number of deals in the Pacific with U.S. debt. We're unable we just realized it was just not going to be possible to get that appropriation through Congress to do those debts. So, but yeah, so those are really the factors. If a country's creditworthy, you're unlikely to find debt to buy at a discount, and then again the multilateral issues, and then there's some bilaterals that are just difficult or uninterested in doing deals.
Right. And sorry, Tom had a question way back. Tom, I don't know if you want to unmute yourself, or are you happy for me to read it?
Sure, yeah. Hi, thanks, Rob. Very informative. I was just curious about whether Indonesia and the Philippines are on your larger list in terms of potential countries. I'm not familiar with their debt situation, but obviously from a marine point of view, it would be a great model in both countries.
Absolutely, yeah. And so yeah, both of them pop up as potentials. Indonesia is creditworthy, so we'd have to focus on bilateral debt and find a bilateral creditor potentially willing to sell at a discount, and maybe at a greater discount than net present value. And Philippines is as well, but it is. We also take into account, who the counterparty is, and so I think with the current government, it would be difficult for us to do a deal there.
Okay, thanks.
I personally have a follow-on question. That basically we're only talking about central government type debt, but might there be, I'm thinking of Indonesia and Philippines specifically, might there be sort of state level debt that's more distressed, or how is that even a possibility or is that too small, if you will?
Yeah, no, that's definitely a possibility. The question is how much debt is there, and is there enough of it to make it worthwhile? But yeah, this can be done at any level, assuming that all the other factors are in place that allow us to do a deal.
Right. Interesting. Okay, and Katie had a question. Katie, if you want to unmute yourself.
Yeah, thanks. Hi, Rob. I had a question about currency risk, because typically the trust funds are best able to manage their investment risk if they can invest or can convert to a hard currency. But if I understand correctly, the debtor nations are paying into the trust fund in local currency. So are the trust funds usually, in your experience, able to convert into a hard currency for investing the endowments? And then who's taking on the currency risk in that case?
Yeah. So the portion of that payment into the trust that is for the endowment is actually in dollars, in hard currency. And so the way the trust will get 65% of the payment in local currency, which is the portion spent on the ground, and then the other 35% comes in hard currency, so that yes, that the endowment is in hard currency. And then the payment schedule is dollar denominated, and so the currency risk stays with the sovereign instead of the trust. So on the day that that payment is due, the government will look at the spot rate, exchange rate, and make that payment. Obviously in some countries where you have a pegged currency, that's not an issue, but not to say in the future date the peg could come off. But in where there's currency fluctuation or erosion of currency, obviously, then the currency risk stays with the sovereign, and the trust only has a limited amount of currency risk, and only on that portion that's going out the door.
Great, thanks.
So I have another question, probably one of the last, but I'm suggesting if anyone has a question, just type your name into the chat box, and I'll call on you. But Rob, I'm curious that conservation trust funds, which are obviously central to the structure and management of this, also one of the fantastic outcomes of the whole program is creating more funded conservation trust funds. But oftentimes it seems that they take time to set up, and for good reason, and that you build stakeholder awareness, you develop capacity of future boards and management. Are you finding that it's possible to move them forward quickly and with the right structure and guidance? Are there no risks associated with sort of speeding the creation of a trust fund?
Yeah, in my experience, we've found that we can. Yes, it is important to build the stakeholder awareness, and we do start out with a one-day workshop in country to get stakeholders up to speed about what the trust fund is, what we're trying to do with the debt conversion, what the marine spatial plan is, how the pieces all fit together. Talk about the design of the trust, look at examples from other places, then start talking about board structure, who should be represented, and usually we try to, at the workshop, spend time on that with stakeholders and get agreement with stakeholders on board representation. And then with that, we can, move into, drafting the documents, and then come back and do a second workshop and present those to stakeholders so they see the process as it unfolds, and then move into creating the entity. To get to the point of to signing the documents, we need the entity to be operational to the point that the board's constituted, officers are elected, key operating documents are in place, operations manual, terms of reference for accountant, auditor, CEO, or executive director, whichever the term they're using, conflict of interest policy, environmental social safeguards, investment policy. And that's where then we do that 2-day workshop to get the board up to speed, to review all those documents, make changes, adopt them, understand their roles and responsibilities. And then, we need a bank account opened as well. And at which point, the trust is in enough of a position, you have a chair and a treasurer and a vice chair, etc. So you have officers who can countersign documents. Obviously, if you can get the CEO also hired, but sometimes that isn't in place. And fortunately, we have coming back to the point about startup costs, through the TED Audacious, we have $70,000 per trust as for startup costs that we can put into the trust, where they can use that money to pay rent for an office, hire a CEO and start paying them, pay for an auditor and an accountant, etc. Because the resources don't flow into the trust till 6 months after the close of the deal. So this gives them some resources to get started. But I feel pretty confident that we can get to the point of closing a deal from starting to talk with stakeholders to closing the deal in 6 months.
That's fantastic, yeah. And I guess we've learned a lot about how to set these up, and you've learned a lot as well. Having done them. Yeah, so it's great to hear that through that structured approach you can move things forward fast. So, well, with that, I want to thank you, Rob, very much for the presentation and for answering all these this barrage of questions. I want to again wish you the best of luck with this audacious program. And if anyone else wants to follow up, you can reach out to Rob directly. Sure, you don't want to be bombarded with emails, but anyway, thanks so much for.
Slide 16
Sorry?
has my contact details, and happy to take an email from anybody.
Okay, and you're happy for us to share the presentation because unfortunately we missed some of it.
Yep.
Okay, excellent. So we'll do that, and we'll share the video as well, the recording. And again, Rob, thank you so much, and best of luck with this.
Great, thank you. Bye, everyone.
Bye now.
Thank you. Bye-bye.
Bye.